So we're here talking about building your cottage legacy fund. So thank you everyone for joining. We're going to create some content tonight, and we're going to be posting this on YouTube and for many to enjoy. So
Right. So yeah, welcome to everybody for joining today. This is kind of a continuation of our journey of taking people through really keeping the cottage in the family. And so last time we did a review of some of the legal aspects, what happened or what has happened with the capital gains tax. Today we're going to dive deeper into, how do we finance some of those things like the changes to the capital gains tax. By the time our kids are our age or adults and looking to transfer on, I'm sure taxes are probably not going to be lower than they are today. So we want to make sure that we're a lot of the discussion we had last time about some of those aspects was about deferring out taxes, which I think absolutely makes sense. But at some point you have to reckon with it. You're going to have to deal with it. So we're trying to address that through this webinar today. And so from Return on Life, it's myself and Dan. We are life insurance advisors. We're going to talk about how to build a cottage legacy fund. Also from Mortgage Architects, we have Jennifer Rossides. She is a mortgage broker. I'm going to do a more formal introduction, but welcome to her as well for joining. Today, we're going to go through more formal introductions, talk about our cottage stories, what why we're interested in this subject, and what kind of drives us to go further along the road in terms of helping Canadian families with this journey. Go through goals and objectives. What problems are we dealing with as cottagers? There's a lot of them are, I guess everybody has their own story, but a lot of the problems are very similar that we deal with. So we're trying to capture what we can, know that this webinar is going to capture at a high level what those are. And then the solutions that relate to that will be very crafted to each person individually, but we're going to talk at a high level to how we address that. And so Jennifer is going to talk about mortgage solutions. That can be a difficult thing to navigate, financing a cottage. Dan and I are going to cover off the Cottage Legacy Fund, and then we're going to wrap up and see how you can connect with us if you have any further questions.
what is special about the cottage? So all these pictures here, we definitely can resonate with what we see. So family, quality time, watching children grow, learning new skills, friend, breaking bread together, reconnecting, making new memories, and of course, water, the peacefulness, the sound of the waves, sunset, sunrises, and then nature, whether that's loon callings, just feeling right, disconnecting, turning the phones off, screens off. This is what's special about the cottage for sure. Pete, I'll introduce you first. So we have Peter Lount, married with two children, son 12, daughter 14, big hockey family, the Lounts. Peter coaches both his kids, loves to travel in the off season, enjoys hiking, and is a foodie, great food. He loves helping preserve memories and secure their legacies in his work while supporting growth and smooth transition into retirement. Ensure lasting legacies for generations to come. So very committed to his service and his craft on helping business owners and families grow their wealth.
Thanks, Dan. And so Dan is married with three children. He's got sons 11 and 8 and daughter at 5. His family really values outdoor adventures, especially his cottage. And I know you've said it a million times that I'm going to butcher the name. So
Cashego Wigamog. Cashego Wigamog.
I gotta learn that for the next one of these. In Halliburton, hiking, fishing. He's a big fisherman. Definitely, Dan's gonna take me out to his boat this summer, and we're gonna hopefully do a bit of that. And then, for him, he knows the value of family moments and is committed to building out solutions to ensure cottages are kept in the family for generations to come. Our experts. So today we have Jennifer Rossides. She is highly experienced mortgage broker with over 25 years of experience in the industry. She, throughout her career, she's guided and assisted numerous clients in navigating intricate world of mortgages. She's known as a trusted advisor, takes pride in her ability to thoroughly understand clients' financial goals and tailor mortgage solutions that align with their long-term objectives. Um, and so the reason we brought on her today is she is also a cottage owner, has a good story around that, and yeah, it can be definitely interesting. It's definitely different than navigating a primary residence mortgage. So that's why we brought Jennifer on. So we're pleased to have her, and welcome, Jennifer.
Thank you.
Cottage stories. Okay, let me start with mine because mine's pretty quick. And actually, last time we did this, I didn't have a picture of this cottage, but I managed to. My mom found a copy of a slide. I don't know if you guys seen these things. The old slide projector. I don't know if it
Totally.
even shows up on my
There it
thing here, but
is.
this is it. So I took a picture with my phone of that cottage. This cottage was built and by my mom's mom, my grandmother on my mother's um side. She had this built. She was basically the GC for it in the early 70s. And she had 7 kids, and when her and my grandfather passed, they decided to sell the cottage. We didn't really have a plan. I don't know if anybody wanted it. Amazing enough, I can't imagine, like, this is, it's up in it's just across the street from Georgian Bay in Thornbury. I'm sure it's well over 7 figures now based on kind of where it's at. Picture's kind of neat because if you drive by it now, you have to go basically right up to the house in order to be able to take a picture of the house because it's covered with trees now. But that's what it looked like in I guess it was probably the early 70s. So Dan, over to you.
Yeah, so I always say I'm fortunate enough to be born into the right family. So this is my family cottage. I am now an owner with my sister and my dad. It was built in 1934 and is very much still the same as 1934. So we really enjoy using it in the summers. My kids are now fully in our embracing cottage life, and it's really, yeah, the cottage scene is really ingrained in the fabric of my family. So very, very fortunate to have it. And I'm building out my cottage legacy plan to ensure that this great piece of real estate stays in the family for generations to come. Goals and objectives. So 3 objectives to really what we're trying to do. We're trying to protect that family cottage. We're trying to build out a multi-generational plan. So not just this generation, but generations to come. And we really need to focus on financing a cottage legacy because these cottages are expensive. They're going to get more expensive. Taxes are not going down. So we need to come up and implement a plan early and often that we can execute and have up and running. Next slide there, Pete. Why do we need a cottage legacy fund? So what is the need? So really that's what we're here, and that's the problem that we're trying to solve. Okay. What are the problems? So we have within the circle, we have maintenance and upkeep. That's expensive. We have property taxes, cottage mortgages, estate taxes, capital gains. These are all threats to the family cottage. These are all problems. Now we have family dynamics on the outside of this circle that in some cases it can be a problem. In some cases it's not, but it's definitely something that it needs to be in the equation. So that's why we have a cottage legacy fund. That's why we're here tonight. We're trying to solve these problems in a smooth way that we can.
All right. And so we get into some of the other problems, diving deeper into the financial side of it as we, in the last webinar we went through this, we had Jim Whitty from Miller Bernstein on just walk us through really what the new reality is, and I guess it is now officially in effect. But in terms of, the end of the day with any type of cottage, as you go from generation to generation, there is going to be a tax, capital gains tax, that going to have to be incurred. So um, that's part of it. So we're gonna, as Dan said, there's lots of problems with the cottage, right? The ongoing dynamics, who's going to deal with, like, the maintenance of it, who's going to deal with, all the various tasks around it. But today we're going to focus on really the financing piece of it. The other piece obviously is property taxes. We know that this is just something that is a moving target. We look years ahead, taxes are probably not going down. Maintenance costs. So that's another piece, not just the actual maintenance of it and who's addressing it, but specifically we're going to talk about the maintenance costs. What does that involve? Um, Everybody's got to have a certain amount that's going to have to happen. I am a homeowner. I know that there's always something to fix. A cottage definitely is as well. And that is not including some major things. Could be septic tank, could be a roof, could be who knows what it is, some kind of structural fix that's coming up, or it could be we didn't cover off on this chart itself, but maybe it's big purchases. Maybe there's other, you're upgrading your cottage. Maybe you're doing different things to do that, or getting a new boat. There's always costs involved with it. Second piece is a cottage mortgage. So, Dan alluded to family dynamics. That could be a big thing. As it moves to generation to generation, maybe the sister wants it, not the brother, vice versa. Maybe they're going to buy their own cottage elsewhere. So then that's where the cottage mortgage may come in, because you're not necessarily going to have the cash to be able to buy someone out or buy a new cottage yourself in that manner. So, in order to do that, we brought on Jennifer. She's going to talk about that, because the actual moving parts of financing a cottage is a lot different than a principal residence, and we'll get her to go into more details on that. So family dynamics, that was another piece, we kind of alluded to, and really it's about who's gonna who's gonna be maintaining the cottage, who wants it at the end of the day. Maybe different generations do not want it. Do you have time to use the cottage? How are you splitting it amongst family members? That can always become an issue. And does, at the end of the day, true dynamics, like, does everyone get along who's at the cottage? So you might have to schedule around that.
All right, so solutions. Family, who wants it? That's one. Okay, so you need to have that conversation with the people around you. You need to make sure that you cover off legal. So that could be estate planning, it could be trusts, it could be wills, but that needs to be in place when it comes to the legacy solution. And then where is the money coming from? So we need to figure that part out. That needs to be streamlined, a plan in place. And again, that's really why we're here tonight, to discuss more about that.
All right, next up is part of this whole process. We did we did a deeper dive in the last scenario, the last webinar that we ran. But really, family meeting is so important, making sure everybody's on board with the plan going forward. So definitely, I suggest this is something that needs to be done, and I'm sure it doesn't necessarily happen in every family, but on at least a yearly basis. Sure, this time of year, people are getting in to the cottage. It's definitely something that becomes um, becomes a point of discussion, right? Like, what are we going to do with the cottage? What's the future of it? So idea is to set up a family meeting, go through, find a obviously common place that works for everybody, set an agenda, make sure that you air out all your differing needs of what people are trying to accomplish over time. Maybe they just want to use it for the next 5 years and they don't necessarily care in the future, but I think the whole reason we're here is because there is a good majority of people that do want to keep the cottage in the family. They want to find a way to keep it going. So this is a good way, at least, to understand what you're working with. And then from there, you can help develop a plan, involve professionals to do so. And so this is the next piece of it, is really the legal aspects. And if anybody didn't catch the last webinar, we had Emma Michaels from Ion Law. She went through each of these transfer options individually and in depth, talking about kind of what your options are in terms of transferring this. And this deals with the dynamics piece, but it also deals with the financial piece too. Putting in something like a trust will defer taxes out. Ideally, for 21 years, at the end of the 21 years, you still will need to reckon with those taxes. And that's what we're going to talk about today. But any of this, like it or not, it's I'd say in any business dealing, including family, can be more emotional and tougher, but good to ensure that you have everybody on board, and make sure you have legal help as well, to make sure that everything's all those loose ends are tied, so to say. Yeah, so the next piece is really, this is where we're going to dive into financing the cottage. The first part of this session, we brought in Jennifer Rossides to talk to us about the reality of financing the cottage, what that looks like, and based on kind of what's happened in the market and over the last, say 15 years. And even, I mean, we had a big jump over the, COVID as well. And so reality is prices are not going to be moving too much. They might have maybe flattened a little bit in the last couple of years. But Jennifer, do you have any comments in terms of what you're seeing in terms of I mean, you're in Ottawa, right? But you're kind of dealing with cottages all over, so maybe out in your area as well. But prices, are they staying pretty similar? What kind of movement are you seeing in the market from your end of
Yeah,
things?
prices last year, the market kind of went down a bit just because it was a bit of a shock of a year for everybody. But this year prices are back up, and I really don't see any of the prices going down, especially in the Ottawa area. Ottawa area is like per capita the highest income area. And everybody has a cottage. Like in my family, we have a cottage, my sister has a cottage, my brother has a cottage now. So if I look at everybody on my street, there's like 7 people on the street here and 2 don't have a cottage. So if you're in the Ottawa area, it is very, very likely you know somebody who has a cottage or have a cottage yourself. And they're close to Ottawa. So the furthest away be an hour and a half that you're driving, not like you guys in Toronto where you're driving a couple of hours to go to the cottage. For us, it's really quick and easy. So the prices are not going down at all.
Right. Yeah, fair enough. And we're going to get you to dive into, what you specialize in on the financing side of it. Do you have any other stories about your cottage or
Yeah,
anything
so we just
in that?
recently went through this whole fiasco, 3 weeks ago, with our family cottage. So my grandparents built the family cottage in 1967, and they took the logs off the land, milled it, built the cottage themselves. It was passed down to my aunt when my grandmother passed away in like 2001 or 2002, and she's maintained it for the last 20 years, and so is her family. And my brother was able to step up and he bought it from them, so we kept it in the family. So it was, it's a very emotional time because you don't want to see it go to anybody else. It's been with us for such a long time, and there's 12 grandchildren, 15 grandchildren. So, you don't want anybody else to have it either. So we were lucky in that he was able to get it. But, there are financing, it's not easy. He has a house, he has 2 kids, and is just trying to figure out how to get the money to do it. Now, it's
Yeah.
not the price that you guys are dealing with in Toronto, but it's still quite expensive.
Yeah, it's still yeah, I mean, either way, yeah, it's definitely tough to swallow. But I mean, what we talked about before the webinar started too was about, just in terms of it's got that different kind of emotion than it does with a primary house, right? It just there's a
Absolutely.
lot more people involved and definitely creates more emotion for sure.
And with that particular cottage and a lot of cottages, it's not a cottage you could put a mortgage on. They run the water from the lake, which isn't an issue, but with some institutions, if you run the water from the lake, then you have to have a water system on it. There's no septic because they have an outhouse. So that's an issue. It's on stilts, so there's no like real foundation on it other than that as well. So again, that's an issue for them. When they were doing the transfer of title, they found that my grandfather was still on title and he hadn't been removed. He passed away in 1987. So
Hmm.
that's another thing that comes up with a lot of these rural properties is the title. So you may be looking to buy that cottage within a certain period of time, but in some cases I've seen the titles be so messed up, it takes 6 months to correct.
Wow.
So, other little things that come up if you have a cottage that's completely off the grid, nobody's going to give you a mortgage for it, which is kind of funny because everybody's trying to push us off the grid. But if you only have solar power, you're not going to be able to get a mortgage. You have to have hydro available to you. If you're on an island, you have to have hydro available to you. So one of the absolute easiest things to do to finance a cottage to make your life the easiest is if you have the equity in your house, you take the equity out of your house in order to purchase the cottage. It's the cleanest thing. But then, and then as we were looking at what you guys were saying, like with multiple family owners, If you have multiple family owners on a mortgage and on title of the property, they all have to qualify together. That's not easy either.
It can be tougher that way, right? When you're saying in that scenario,
Absolutely.
right? When you add more people, it doesn't necessarily add more, the bank's getting you all for the same price basically, right? And but it could actually be a negative as opposed to a positive when they do that, right?
It is, because you have somebody who's self-employed like myself. So, I'm trying to maximize my taxes or reduce my taxes as much as possible. You may have somebody who's had, some credit issues in the past or something as well. And you may have somebody who's retired and can't support all the debt. So then how do you do it? So those are, again, like when you do have those family meetings, like you really have to dig down if you are looking to finance the cottage, and how you do that and what is the best way to do that, and who is on title and who isn't on title. And then what plans do you have for that to protect the people who aren't on title of the cottage?
All right, Jennifer. So what I'm on, do you see the slide I'm on now? Am I
Yeah. Yeah, so there's different types of, so you can finance a cottage up to 95% of the value if it is basically a house cottage, right? It's a 4-season area. You have a well, septic, completely livable, heating, everything like that. You can actually purchase it for 95% of the financing. Well, up to 500,000, and then you have to put down 10,000, 10% over the 500,000, up to $1 million. Anything other than that, then you can put down 20% to purchase a cottage on the type A properties. A type B property is going to have a little bit more limited road access. They will have a little, they may not have like full plumbing in the cottage. They can have like a chemical toilet or something of that nature. Those would be a type B cottage, and you can do 80% of the value there. But again, anytime the bank is looking at it, they want to see that it is marketable, that they can sell it if they had to. I mean, there's always private mortgage. Private mortgages, we do them all the time on cottages. And then a way to buy a cottage from somebody who is has been up there forever, is to give them a mortgage on the cottage. So say my grandfather has a cottage, I give him 20% down and he holds a mortgage for me. So there's a lot of old people in the rural areas who are used to doing that. And that's a really great way to do it, because then it's an income for them as well. There's always a way, you just have to find it.
Absolutely. Should I go to the next slide? I got type A cottages.
Sure.
Okay. And so you kind of been going through a lot of this.
Yeah, sorry. Yeah, I kind of
Right?
skipped through it. Again, like type A cottage is basically going to be, your house cottage. Somebody, is not going to be in a really, really rural place. It's going to be very marketable, like, Wasaga Beach, those type of cottages. Something that is very, very marketable to the banks. And again, you can put 5% down on a cottage like that. And there aren't a lot of parameters around it other than the fact that, you have to have it fully serviced. It has to be heated. It can't be just run off of solar or anything like that. You have to have running water. You have to have a septic system and all that.
So even though it's a secondary residence, you can still go as low as 5%.
Yeah.
Jen, will that be do you have to get an insured mortgage on that, or can it be uninsured with the 5%?
That's insured.
Okay. So you
Yeah.
would have to, there'd be obviously
See,
money on top of that.
Yeah. So like you do the CMHC insurance, and then they add the insurance to the mortgage. So anywhere between like 20% down to like 5% down, you can do it that way. But again, the qualifying for that is difficult, because then it is a stress test, but it is absolutely possible. You can't refinance it to do that though. So if you're taking money out in order to do the renovations, do the renovations to the property, or take money out, to fund your legacy, you can't take it up that much. You can only go up to 80% of the value. And in some areas, if you're in very rural areas, the banks will, they call it cut it back. They won't lend you as much money as maybe you want to have. So again, it all depends on the location of the property, the type of property, and how marketable it is. And everyone will have to have an appraisal. Because the appraisal will then determine the lifespan of the home or the cottage and the marketability.
Right,
The
and
other
I go,
thing to note too is the banks don't never ever 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 tell them you're going to Airbnb them. Because they will say no, and they can't be timeshares. So you can do it after the fact. It's just you can't tell them you're going to do that.
Timeshares is in like kind of fractional ownership with
Yeah.
family members.
Yeah, they will not do that.
Right. But you could do the cottage agreement afterwards with family members or people
Absolutely.
on the private side. Yeah.
Yeah. Yeah. What you do afterwards is your own business. As long as you pay the mortgage, they're not going to bug you. Yeah. That's
All right. So it's kind of the A, B, and
the
yeah.
other, was there anything
Yeah.
else that,
It's, it's just having like, it's just having the accessibility, right? So again, the A mortgage or A property is just having year-round access. That is key. So they call it either a 4-season cottage or a 3-season cottage. And a 2-season cottage you would have no road access in the winter. So that would be an island. And then
right?
again, that's when I said before, like an island is difficult to get done. So they would probably cut you back to 65% of the value of the property.
The other piece you have in the last part is about purchasing Quebec.
Yeah. So again, Quebec is just, it's a different, like I said before, it's a different beast in itself. If you do purchase a property in Quebec, you have to have a will that is prepared by a notary in Quebec, and it has to say what your wishes are, because Quebec will not recognize any other will outside of the province.
Right. Yeah, we had when we had Emma on last time, that was actually something that came up because we had some people that had properties outside of Canada or they're Americans coming back to Canada, but always her recommendation was always to make sure you have local legal assistance wherever that property may lie.
Yeah. Yeah, you absolutely have to do that anyways, but it's just asking them for all the different little things. And again, the will is something that is, because we all have cottages in Quebec here, like I can see Quebec from my backyard. And a very large portion of us do not know they have to have a separate will. And it's only by chance that I learned that through my career. Had no idea it was supposed to be that way.
Yeah, it's amazing these things we find out after the fact, right? Or when it's not too late, but it's a lot more expensive. And that's kind of, where, the business that Dan and I are in is, inevitably these things we're going to have to deal with at some point, but it's a matter of, how much we're going to pay in order to fix or to get accomplish what we're trying to accomplish.
Yeah.
Well, that's good. Well, thank you, Jennifer, for adding context into it. We're also going to send out your contact info to all the folks that were on this webinar and the one before as well, just so that they can, if they have any questions on it,
Yep.
they'll be
By all
able to
means.
reach out to you. Yeah. Okay. Well, thank you so much.
thank you. All right. So how do we pay for the cottage? There could be traditional ways like a savings account that people have. There could be selling of a stock portfolio. There could be selling of real estate. These are all ways that you could come up to fund what is needed for the cottage, whether that is taxes or whether that is capital gains, et cetera, et cetera, et cetera. We're here tonight to talk about another way. We call it a multi-tool, financial multi-tool. We also call it the Cottage Legacy Fund, and it is known as, and we're going to talk more specifically about cash value life insurance. And I'm really excited to dive into this because I think not enough is known about this tool, this financial tool. And I love having conversations with clients and individuals and seeing the light bulb moment go off with these people as they learn what this multi-tool can do for themselves and their families for generations to come.
Yeah, I think important point of what you've got in this slide, Dan, is everybody's already got a lot of these things in place, right? They've got stock portfolios, they have savings, they have other real estate. How do we make it better? That's the idea. So we're not saying take all your money and put it into this fund. We're saying here's another way that can help alleviate and address some of these things without having to necessarily sell your stock portfolio or sell your real estate. This is a way to enhance that journey.
All right. So what we have here is we have a picture in the top right of myself and my two sons. The whole idea is to show sort of the generational effect. So what the plan could be, it could be putting a cash value life insurance policy on the owner of the cottage. And then the next step could be the next generation. So my kids who do have life insurance policies on themselves. And then when the grandkids come along, putting life insurance policies on them at a very, very young age. And what we've created there is a succession plan where we have the death benefit can jump from one generation to the next to help alleviate the pressures of the taxes, of the maintenance, of the various aspects, the pressures that the cottage is going to put on it. So that's the whole premise of what we're trying to accomplish and what this slide represents. What is cash value life insurance? And we have two houses here, and really the best way I think is breaking it down where you own your house and you rent your house. You own your insurance or you rent your insurance. So we are very familiar with term life insurance. And term life insurance is you are renting your life insurance for a specific amount of time, 10 years, 20 years, 30 years, etc. But you are renting. When you rent your house, you are not participating in the equity that is being built inside that house. The owner of the house is going to be experiencing the buildup of equity. Well, when it comes to life insurance, we build out these life insurance policies where you are the owner of the life insurance policy, and the money that you're putting in and the gains that the policy is getting and the way it's designed is building up equity inside that life insurance policy. So it is very similar to owning your house where it's creating equity. Your life insurance policy is also building equity. And we're going to sort of dive into what we can do with that equity in the slides to come.
Okay, so over to me, and just to follow on Dan's point, we definitely are focused on the permanent insurance. We do have solutions that involve term insurance as well. It definitely can bridge a gap, can be a useful solution to add to whatever someone's journey is part of. Point of where you make about not building equity. The other thing is too, when you say it's renting, it truly is. I think of it similar to some of the other insurances out there, right? Where people are like, oh, why do I get life insurance? It's just like another bill, like car insurance, like house insurance, whatever it is, because it pays out less than 2% of the time. So it is literally something that is great, to bridge a gap when it's needed the most, but it's also something to for big consideration why we look at permanent whole life insurance. And so cash value life insurance, we're kind of taking that in a way, and we call it cash value because it's really how we build the contract itself. So it's a contract between you and the insurance company. They have to, your responsibility is to pay the premiums over X amount of time. You can choose when to stop, whatnot, but we have people who have the opportunity to pay till age 100 if they wish to. But the idea is like with this contract, it's unilateral. So you put in the money, the insurance company has to pay that bill eventually. And they know in order for them to reduce the risk, they have to grow that cash because they have to offset that bill that's going to pay eventually. But in the meantime, what's happening is that growth is happening contractually. So daily, every single day, it's growing. It's accumulating tax free. You're able to use it as a policy owner. You have the right to be able to access it, similar to what Dan said. Like real estate, you can actually you can either borrow it directly from the insurance company, or you can collateralize at a bank as well. And there's so many, when Dan talks about being a multi-tool, there's so many different uses. We're going to talk specific to cottages, but we see people using it for growth, for any challenges they have in life. We have, people using it for retirement, and then of course legacies, where this fits in a lot. And so in this case, you're going to get a windfall of money at the end. So it'll pay out to the beneficiaries tax-free, avoids probate, pays out directly to the family members. I give you an example of, a probate. If everybody's familiar with the former mayor of Toronto, Rob Ford, his estate was sitting in probate for 7 years. If there was life insurance in there, it would have been something that could have paid out directly right away. And so when we talk about using it for this purposes, we're talking about extinguishing estate taxes. So capital gains is essentially what we're paying when we pass this asset on to the next generation. Allows you the opportunity to decide if you want to keep the cottage or not, and not have to sell other assets and able to extinguish that tax. And as Dan said from his previous charts, we talked about really building a generational asset that you're able to pass on over and over. And we're going to get to an example now that'll talk through. I've got 3 examples basically based on what Dan had talked about, the 3 generations. And so this is really an aim to tackle the estate taxes. And so in this case, we've taken a cottage owner who's looking to extinguish, estate taxes or capital gains specific to the cottage. We look at the example we had previously. I think that the cottage that was bought for $200,000 sold for 1.2, or the state tax was based on that, was about $330,000 in taxes that had to be paid out. And so, that becomes, I don't know, like from a habit perspective, how many people are going to have that money stored, and then you have to go into different things. You have to hopefully have some savings. Maybe you've got a stock portfolio, maybe you've got other real estate to help deal with it. This is our way to help alleviate that as well. So this case, it's a life insurance policy that's paid in for 15 years, or 15 years at 10K, so $150,000. The typical life expectancy is about age 85. And so by that time, they've fully paid into it. So they're already, they stop paying at age 75. And so at age 75, you see that the cash value in the policy has grown extensively. The age of where we expect the benefit to come out is, age 85, continues to go till age 100. But here's where this plays out. So this cash value can be used throughout your life as a loan, borrowed at 90% throughout your life, or to collateralize at a bank at 100% typically, and pays out a benefit. So the benefit will pay out the benefit itself minus whatever you may have used in that lifetime as well. So that's the cottage owner really taking care of estate taxes. The next one is we get into the next generation. So start at age 35, 15 years, 5K. And really, like, when we look at these things, it is so individual. Everybody's coming from a different place, going somewhere different. So we're literally throwing out examples, but your example may be totally different than this altogether. We get all kinds of questions on this. I'm too young. I'm too old. I'm not healthy enough. All these things. These are all like very valid questions, but things that we can address in a more deeper conversation. So the context of this is like, let's look at this at a high level and what impact it can have on the family. So this case, we've done $5,000 into a policy over 15 years, total of $75,000. You can see that, they have access to, up to $1 billion by age 85. If they choose to use that. If not, it'll pay out the death benefit minus whatever they used at that point, pays out. So this is accumulating tax-free. It pays out tax-free, avoids probate, but it really just gives you a financial flexibility to use throughout your life in the context of a cottage. Some of this cash value can help in terms of challenges. Could be, you know, say a roof's gone or boat motor's gone, or, you know, we're going to go through some of those examples later on, but those are definitely things that can come up. Could be something that covers property taxes, right? And at the end of the day, when you use the collateral in something like this, you actually choose the repayment terms too. So there's no bank or insurance company come knocking at your door asking you to pay it back. They know they have collateral because at the end of the day, they're going to get paid. And so that's really where we see this as a great benefit, an additional tool to whatever you're doing financially. You may have built your wealth through, you know, through your business, through high income, through real estate, through whatever it is. You're going to seal it in with something like this. This is the one tool out there that is, if I go through, we talk about tools that are tax free. Let's list them out. I could list them off in one hand, right? Primary residence, right? We know that is going to grow tax free. You can pass that down tax free. TFSA is another thing, right? It's got limits to it in terms of the amount that you could put in, $7,000, $7,500 a year, and then a lottery ticket, right? This is the fourth thing is life insurance. So we see this as a great asset to add to whatever mix you're wherever you are in your journey. And then the last generation, the grandchild, is putting $2,000 a year into a policy. This case we did literally paid out till age 100. So last time we did a case where it was a newborn child, 10K a year over 20 years, and there is actually a difference in terms of what it builds out, but this talks to, there's so many options in terms of how you can configure this. In this case, it's basically setting the kid up for success down the road. And think of when the life expectancy, so that's going to more than cover the cost of taxes, but it also acts as I think of people, when you talked about people building out their wealth or their reserves, you want to be able to have enough to spend to the end, right? Well, this is another tool that you can use. So many of these things like defined benefit pensions, unless you're a teacher, it's very rare to see these retirement plans around. This can be a great tool that that it's got a guaranteed growth on it. So if you ever need to access it, like say you're in retirement, you're trying to deploy funds from your stock portfolio and the stock market takes like a 20% hit. Well, this can be a great piece to access from. I have a lot of people that will take this and collateralize at a bank and use it for retirement over time too. And there's still whatever's left over goes to the family, tax-free. Dan, over to you.
Yeah, so good there, Pete. And the numbers they're incredible to see what you're seeing when like on that 2K policy for an infant, and then you're looking at like $3.2 million at age 85 or 90. There is massive compounding that is happening. And one of the advantages of these life insurance policies is once your money goes in, it's locked in there as in terms of it is compounding over and over and over every single year. And we all know that your money compounds uninterrupted, it grows every day, and you still have access to your cash value or your equity through a policy loan. And that's what's beautiful is you're not borrowing your money, you're borrowing the insurance company's money. Your money is still inside that container, growing and compounding year after year after year. And what we're naming this can be your Cottage Legacy Fund, where it's used at the end, but it's also used ongoing as well. Next slide there, Pete. What we have here is a really, really cool chart. So it's uninterrupted compounding on your money. And you can see here the compounding effect where if you leave your money just to compound and you're not interrupting it, you can see this beautiful chart and how it escalates all the way up to 350,000 by year 30. So nice gradual upswing, uninterrupted. if we go into the next slide and we put in interruptions there in the yellow, okay, where the compounding is interrupted. So let's say every 5 years you need to purchase a vehicle, or let's say every 5 years in the cottage, like a roof goes, and then the boat goes, and then the docks need to be replaced, and then et cetera, the septic system or a water source, your money is always getting interrupted. You can see it's never having a chance to compound and grow. And really, when I was being exposed to this cash value life insurance back in 2019, and I started to implement my cottage plan, this was one of the major advantages I saw. Was there's a multi-tool that I can put my money into where it's uninterrupted compounding of my money forever in my life, and then into my kids' life as well. It's a very powerful chart there. Next slide there, Pete. Love this. A penny a day that doubles every day for 30 days. And we can see here the really, really powerful effect of compounding and that growth. So day 1, day 2, day 3, day 4, and then all the way to day 31, we have $10 million. Now look at the difference between day 30 and day 31 is double. So 5 million to 10 million. We just need to get our money into these systems and let it sit and let it compound and let it grow. But once again, if we interrupt it, all right, in the next slide, Pete's going to show that, boom, all right, we have the dock needs to be replaced, the boat needs to be fixed. You have this interruption, it slows that compounding extremely down. And you can see here at the end, day 31, we only have $2.6 million and not $10.5 million. So much, much difference. The power of compounding is one of the major advantages of this tool. All right, next slide there, Pete. I think this is off to you.
Yeah, so when we talk about this as a multi-tool, definitely there's so many great attributes to it. The chart I showed of the examples, I give an example of, it would be similar to something where people would put into fixed income like a GIC, except the, GIC, in order to, a taxable GIC would have to grow at about 12% to equal what you get through life insurance, because it's accumulating accumulating cash daily, tax-free. You don't have to worry about all those other pieces at the end. This contract is the responsibility of life insurance to grow. It's your responsibility in terms of how you use it to impact how much it grows eventually. But the growth is growing contractually. It's liquid. So we talked about some of those things that Dan had talked about before. So being able to access it for you could literally take it out as cash if you want to. You're going to stop the growth, the compounding of it. But we like to see it as something that if you need to do that, then absolutely do it. Or you can borrow from it like real estate. And it comes with that, when you're borrowing directly from a life insurance policy, you don't have to go through credit checks or all that. It's private. So people can't sue you for you. If you're named to a beneficiary in your family, they're not going to be able to take that away from you. I have a story coming up as well that I'll talk about that impacts that as well. It's protection. Obviously, that's the basis of life insurance. If something happens, then it will pay out. It's flexible. We're talking about this in the context of a cottage legacy fund, but can be used for so many purposes throughout your life's journey. When we talk about, things like, as I said, I believe people will make their money through different ways, build their wealth through investing, through real estate, through business, whatever that may be, right? But this is one place where that your money's safe. It doesn't suffer losses. It's not have that great impact that you see on other assets from a market perspective. The volatility on a life insurance contract is less than 1% over 10 years, right? You could literally see, I don't know if you're into something like Bitcoin, there can be really big flexes. I mean, that may be something that's going to grow multiples over time, but it's going to have a lot of jumps in between. Real estate in itself too is going to grow over time. We know, I'm confident that people can make their wealth through that, but there's going to be challenges throughout. There might be uh, market shifts that may happen. When you need that money, this is something that you know that's going to be there. You talked about private, judiciary protected, you can't be sued for it. And I call it like a tax container. It grows tax-free, pays out tax-free. You can use it tax-free throughout your life. Important part to this is there's a lot of great elements to this tool, but making sure you build it correctly and work with the right people to make sure that it does work the way that we say makes a big difference too. And so we go into this, we call it the Cottage Legacy Fund. And I like to call it a fund because, the example I gave of a lottery ticket, literally life insurance can be like a lottery ticket, can pay out to your family tax-free, and there's a pile of cash. We think of it as, don't just, that it's an important piece to it, but we think of it as something that needs to have some parameters, have family involvement, have legal involvement, make sure that you want what you want to have happen to your funds is taking place based on your terms. And so if we can build not just the life insurance, but also add in some of the elements, maybe a family trust, whatever. Example in this case is like build something like a family trust around this that'll ensure that the funds from this, the proceeds from this, go directly to cover capital gains in the cottage, pass it on to the next generation, and extinguish the tax. Yeah, so ongoing usage, it's not something that, typically people think of life insurance as if something happens, then, if someone passes, then we get paid out. The way that we work with it is like, it should be a tool that based on whatever you're trying to achieve, we should be able to do it. And you can adapt throughout your lifetime because we know that no one's path is directly as they see it. There's going to be challenges, there's going to be opportunities coming up. This is a great tool which we can help, which we help our clients with be able to use throughout their life. And then, can't state this enough, the tax-free accumulation on a daily basis. And you talked about the similarities between a TFSA and real estate. I kind of call it a combo of the two. When you use it right, you can definitely create great impact for yourself.
All right, over to me. So we talked about that equity inside the policy that you can access. You can access to do what you need to do with it. So much like on a house where we can put a HELOC, a home equity line of credit on a house, and you can access that equity inside the house. We can do the same thing with our insurance policy. We can access the equity inside the insurance policy. So let's say the roof goes on the cottage. And, where do we get the money from? You can get the money from the insurance company. You can take a policy loan. The money is going to show up in as early as 48 hours into your bank account. Boom, the money is there. You pay the roofers, and then you can replenish that policy through loan repayments on your own time when you want to. So it's very, very powerful. You see here a picture of my son Hudson with his with a brand new 9.9 Yamaha motor that we purchased this year for him. He's 12 years old, just got his boater's license. To pay for this motor, I didn't take I didn't take a loan. I went to his insurance policy, Hudson's insurance policy that we've been having in place since 2019, and we borrowed the money from the insurance company to purchase this motor. And what we're doing is we're making payments back to the insurance company for this motor on our time. So the flexibility is fantastic, but it's a different way of thinking, a different way of doing. So not only is his insurance policy in place, but he's able to use it to fund things that we need in life, in the cottage, etc.
All right. So I have a couple of just examples I want to talk about. They're more stories than anything. And the first story is about two business owners. So the business owners did really well. They ran the business for 40 years and then have since retired, and are living off the proceeds of the sale of their business, as well as they both have real estate one has like a healthy real estate portfolio. The other one had literally multiples of the first one. But the second one, who did so well in real estate, actually ended up losing it all in the last couple years. And you know, so unfortunate to him, he didn't have anything left. But he did have, when they started this business 40 years ago, they actually both got, as business owners, got life insurance contracts. And so he has over $4 million of cash value sitting in his life insurance contract, which whatever happened to his properties happen, no one can access this life insurance. So he's able to access that fund, retire off with whatever's left there, and then whatever left at the end will pay out to his family at the end. So amazing where it can come in. He's using it in the latter stages of life, not something he planned for, but something that he can access when he needs to. Another one too is I had a friend who's told me he had done this in the last number of years, but he said the point where they got to point, this is before this new rules of the capital gains tax. So he said, you know, like we're starting to pay capital gains, whatever it was at that time. He said the big thing is that you know, he said we'd have to sell our sell our house in order to pay for the capital gains taxes. They didn't have other real estate or whatever, they had their house. And that was something that was a reality for them. So they put the right pieces in place, family trust as well as life insurance. And now that family's going to be able to pass this on to the next generation. Third story I had was really about the Rockefellers and the Vanderbilts. So I've got a book in front of on the screen here. And I actually don't know if it sells anymore because I think the Rockefellers might have stopped them from using the name on it, but really talks at a high level about the Rockefellers, and it can contrast them with the Vanderbilts. So the Rockefellers, if anyone's familiar with the name, it's out there. They're very successful in business, 6 generations deep of family wealth, over and over and over again. They have obviously great business, but also great systems and processes and, you know, pieces in place to ensure that the wealth will continue on generation to generation. That includes family trust, proper estate plan, and life insurance. The Vanderbilts on the other side were, I believe, richer than the Rockefellers 100 years ago. They had over $200 million, so which doubled the U.S. Treasury at that time. And within 2 generations, they had spent it all. They didn't have all the right pieces in place. And that name you probably hear all over. They became kind of socialites. So there's mansions around the U.S. There's Vanderbilt University, which is obviously a big donation that they made at the time, but the succession didn't sustain. By the 1970s, the family had a reunion and there were no millionaires left. There's one, you know, remaining that we probably all have heard of as well from CNN, Anderson Cooper, but his wealth was not built through his family wealth. It was self-built through his television career. And the only other point I've said it before is like, there's so many things that we do. We work on avoiding taxes or deferring taxes on. When we build this out, we're building out a process to dispose of those deferred taxes. And so the highlights of the Cottage Legacy Fund would really include understanding of your long-term vision, what you want to do. But really, when it comes to a cottage, we're thinking multi-generational. We don't want this to leave. When we talk about a cottage, it's something that has generations of memories that are passing on. And you can pass on those memories from generations past to generations future. Imagine the power of that. And that's kind of the power of having a cottage, I think, in itself. It just aligns to your family goals. You know, you can build family memories literally from having this part address some of the financial side of things, which will allow it to be able to fund and make it sustainable for the family. And then as we've mentioned throughout as well, this is something that can address ongoing things that are happening. So maintenance, ongoing taxes, upgrades that are happening. And then of course the capital gains tax in transition from generation to generation. And then, you know, I always say, you know, when we talk with this, you know, I mentioned before, it's not like a lottery ticket. Make sure that you have all the right pieces in place, right? So obviously the family cottage is key cornerstone to all of this. there's some kind of funding or savings accumulation that you may have. And as we said, what we are doing is we're doing it as an enhancement to whatever you've already created. So this doesn't displace savings or other assets that you're accumulating. This is building kind of like a an asset that's going to grow contractually at the end of time. It's giving you access to cash value when it's needed the most, but also accumulating tax-free throughout time. But it also includes the right agreements to this as well, too. So, an example is we had Emma from my in-law last time. She talked through all the different scenarios, and it really depends on what your family's trying to plan out. But our goal is to make sure that we address all these pieces, and if it's something that we can't handle ourselves, then we'll entrust the right professionals, whether it be CPA or lawyers as well. And as well, obviously we have Jennifer here today too. So when it comes to other types of financing pieces, we like to work with people who we know that have that experience and can help out. And so working with those professionals, building that solution that meets all the elements, and then be able to be adaptable over time. I think that's so important because everybody's, as I said, everybody's life is kind of changing over time, and be able to adapt with those times is so important too. We do reviews with clients and execute on plan. And what I don't have in here as well is also just making sure you're addressing on an annual basis to make sure that it's fulfilled. Our process. So as we kind of wrap up, I think I've got QR code here. If you want to connect with us, I just gotta do a little adjustment here. So with us, we offer always a free consultation with our clients just to talk about, just get an understanding of where you're at. Love to hear your cottage stories. There's so many different stories out there, and we want to ensure that people are able to keep those memories alive and going on to future generations. So the idea is set up a call with us. We go through a bit of a discovery, understand where you're at, what you're trying to do, bring in professionals as we need to. And if it even gets to a point where we decide that it's something that we can work together, then we do a presentation and if ready, execute a plan. And he said, when it comes to this, there's lots of moving parts. So something like life insurance might be a lot quicker than setting up a family trust or estate plan. Those things can take time, but we can make sure that they integrate to each other over time. So the idea for us at the end of the day is always understanding where you're at, understanding, what you're trying to accomplish, and understanding that things may change over time too. And so we hope that you enjoyed the time today, and will connect with us to follow up. And we're going to have more coming out throughout the summer, throughout the season on this. So look forward to seeing us out there. Want to thank everybody for joining us. There's a way to connect with Dan and I as well. Either email us directly or set up a meeting directly with us.